All right, let's get right into it. Welcome to today's Explainer, where we're going to break down exactly why the economic landscape of 2026 has fundamentally altered the mechanics of the next potential market downturn. We're going to unpack some really crucial economic indicators together, and by the end, you'll see exactly why the next crash is going to look very, very different from the ones in our history books.
A recent report from TD Wealth used a really great analogy. They pointed out that the economy right now is kind of like a jet plane descending through the clouds. We know we're coming down from the absolute peak of a massive growth cycle, right? But the big question is, we have to figure out exactly what happens when the rubber finally hits the tarmac. It's a completely critical moment. We're transitioning from this wild period of pure narrative and hype into a reality where the real costs of capital, well, they actually matter again.
Now, to understand where we're going, we obviously have to look at where we've been. We're all pretty familiar with how markets historically reset. We had Black Monday in 1987, which is actually what birthed the trading curbs and circuit breakers we rely on today. Then you've got the dot-com burst, the 2008 global financial crisis, the pandemic shock, and of course, that unprecedented $3 trillion drop triggered by global tariffs back in April of 2025. But here's the catch. Relying solely on those past blueprints, that might actually be our biggest blind spot right now.
So here's our roadmap for today's Explainer. First, echoes of past crashes. Second, the everything bubble. Third, rise of the machines. Fourth, the debt anchor. And finally, surviving the paradigm shift.
Okay, Section 1, Echoes of Past Crashes. Let's look at the historical baselines, setting the stage for what we're experiencing in the global economy today.
The Brookings Institution put together this really fascinating comparison between the 1970s stagflation and the 2020s. And the good news is, today's central banks have far more credibility. They have clear mandates for price stability, and our economies are structurally much more flexible than they used to be. We just don't have that same rigid wage setting from the 70s. However, there is a massive shift when you look at our fiscal stance. We are currently carrying an unprecedented level of normalized fiscal deficits. So we're basically walking a very different and very heavily burdened tightrope.
Which brings us to Section 2, the everything bubble. Because right now, there is truly no place to hide.
To really grasp the sheer magnitude of market valuations today, we have to talk about the CAPE ratio. Developed by Robert Shiller, this compares current stock prices to average inflation-adjusted earnings over the previous 10 years. And listen, this isn't just academic trivia. Historical analysis shows that this one single temperature check explains up to 85% of the variation in future 10-year market returns. It's honestly one of the absolute most reliable indicators we have.
So the crucial takeaway here is that right now, the CAPE ratio is sitting at an extreme 42. To put that into perspective for you, the CAPE ratio peaked at 44 right before the entire dot-com bubble burst. At 42 today, you have to ask, are we just ignoring the warning signs? We're sitting at a level that is practically screaming caution across the board.
And this creates a really fascinating yet pretty sobering paradox. The Hub recently highlighted this beautifully. They said there is no diversification away from the problem because the problem is the diversification. Think about it. In the early 2000s, you could hide in value stocks or international markets. When stocks fell, bonds usually rallied, right? But today, US equities, international markets, gold, copper, Bitcoin, they're literally all sitting at peak valuations simultaneously. That traditional 60-40 portfolio shield, it has been fundamentally compromised.
Adding serious fuel to this fire is the sheer concentration of the market. Just 10 companies make up 40% of the entire S&P 500 index. 40%. That is the highest concentration we've seen since the 1960s. And why does this matter? Because if just a handful of these massive tech names show weakness, it doesn't just hurt one sector. It violently pulls the entire broad index down with it. It's a massive, massive internal fragility for the market.
Let's move into Section 3, Rise of the Machines. We need to talk about algorithmic speed limits and a brand new variable that simply didn't exist during past historical panics. There's this incredible archive study on systemic risk, and it points out a massive structural change in our markets. Historically, human panic was measured in days and weeks. People read the newspaper, called their brokers, took time to react. But today, because of AI and automated trading, the next crash will be dramatically faster. We're talking minutes and seconds. It is a completely different temporal reality. Here's exactly how that algorithmic crash sequence plays out. AI creates this unified model of dependency because these trading algorithms are basically all training on the exact same data sets and signals. When a trigger hits, something called performative prediction kicks in. The algorithms engage in herding. They literally all sprint for the exact same exit at the exact same time. This causes liquidity to just instantly vanish across multiple asset classes, leading to immediate sharp price declines before a human trader even has time to blink. The circuit breakers are going to trip faster than we've ever seen. And that brings us to Section 4, the debt anchor. Let's explore why the government might actually struggle to rescue us from that kind of rapid decline.
See, the entire buy anything era of the last decade relied heavily on government bailouts and rock-bottom interest rates to save the day. But look at our structural shifts for 2026. U.S. government debt exceeds 100% of GDP, and we've normalized annual peacetime deficits at a staggering 6%. Meanwhile, regular everyday households are already locked into low mortgage rates from years past. Because of these unprecedented fiscal deficits acting like a giant anchor, the Federal Reserve simply has much less room to maneuver and rescue a falling market.
And you can actually start to see the cracks forming in the foundation right now. The Federal Reserve's own Financial Stability Report from May 2026 noted that Treasury market depth has been incredibly volatile. That means underlying liquidity, the actual ability to buy and sell without moving the price drastically, is sitting at historically low levels. The system might look totally calm on the surface, but the plumbing underneath, it is highly stressed.
Finally, Section 5, surviving the paradigm shift. We know valuations are stretched, the algorithms are waiting, and the government's hands are tied. So what actually triggers this, and how do we prepare?
Going back to TD Wealth's jet plane analogy, the year of narratives is over. We are well past the hype phase of endless AI promises and infinite growth. Now we're operating in a real economy where physical limits, massive electricity needs for AI data centers, and the very real costs of capital are taking over. The runway is approaching fast, and the market is going to start demanding real earnings, not just big ideas.
Now, obviously, a massive crash isn't guaranteed to happen tomorrow morning, but we are facing a literal wall of worry packed with heavy catalysts. We've got looming commercial real estate refinancing risks as old loans finally expire. We have persistent sticky inflation forcing ongoing monetary tightening. And on top of that, the Fed highlights severe risks from potential cyber attacks, alongside global geopolitical friction and trade policy uncertainty. Honestly, any single one of these could be the spark that tips those algorithmic dominoes we just talked about. Which brings us to the harsh, mathematical reality of buying at the top of a peak. The risk dynamics have completely flipped upside down. With valuations this extreme, remember that CAPE ratio of 42 we discussed earlier? Experts project the real return for U.S. equities over the next decade to be a meager 1%. Meanwhile, 10-year Treasury inflation-protected securities are contractually offering over 2% in real terms. History consistently rewards discipline over prediction. So as we face this completely unprecedented mix of light-speed AI trading algorithms, heavy government debt, and historically stretched valuations across literally every asset class, you have to ask yourself a tough question. If reversion to the mean is the only enduring law of markets, is your portfolio truly ready for the end of the buy anything era? Think about how you're positioned for reality with the next 10 years look absolutely nothing like the last 10. Thanks so much for joining me on this explainer, and I will see you in the next one.